Welcome to the Wall Street Geek, where we ask not what your geek can do for you, but ask what you can do for your inner geek, like becoming better informed about important money matters. This week's story is actually for the ladies, although guys may be interested in hearing it too. Time magazine had a big article this week about whether marriage can be saved. For women who are interested in pursuing marriage, the question is often, how do you know if the guy that you picked is the marrying kind? Maybe you picked him because he's hot or smart, but the best way to determine if he's a good candidate to marry is to not only check if he's a good person inside with a good future, but to also figure out if he's ready to be married. They say it's like hailing a cab. When he's ready, he'll turn on his roof light and signal that he's open to taking passengers. Without this indicator, even the highest quality man isn't ready and isn't the marrying kind. Which leads us to today's topic. Some investors use fundamental analysis to determine if a stock is a good buy, like value and growth investors. Some only use technical analysis, like day and swing traders. But the best way to pick a stock to trade is to use a combination of the two. The majority of successful investors use both to some extent. How? Well, let's look at the components. First, what's fundamental analysis? That's where you evaluate the business behind the stock to determine the company's true value and future potential. The market isn't efficient 100% of the time, meaning prices aren't always reflective of a stock's true worth. This is Warren Buffett's point of view. So when a trade is placed for a stock that you feel is trading for less than it's worth or undervalued in the market, the hope is that when the rest of the market catches on, the price will adjust upwards in your favor if you went long or purchased the stock at a low price. On the flip side, if you feel a stock is overvalued, you can take a short position instead of a long one, meaning you sell it and then buy it back to cover your short position when the rest of the market catches on and adjusts the market price to a lower price. A fundamental analysis includes looking for growth in past quarterly earnings at least over the previous 3 years. Also, have earnings been stable without peaks and valleys? Is debt to equity less than 1? Is P to E on the low end of its historical high and low range, meaning that it may be a good buy? Which institutions hold positions? That you can find out for free on Yahoo or Google Finance. You can also check if management owns at least 2 to 3% of its own company stock. Cash flow, is the company reinvesting in its own business? Or are they paying dividends, which some say suggests that there are no growth ideas for the company to invest in? But that doesn't mean that it's a bad investment. It's just that it may be in a stable growth phase. Investors who are for fundamental analysis say that it helps in finding companies with profitable ideas and a solid foundation for steady long-term growth. But people who are against it say that just because a stock represents a good company, that doesn't dictate what will happen to its price in the market. That's why investors use technicals. A technical analysis involves analyzing a stock's price action. And some say this analysis can tell you whether it's time to jump in or jump out. There's a saying, the trend is your friend, that analyzing price trends can tell you about the support that a stock has in the market. Some believe it and some don't. It's up to you as an investor if you want to put faith in trends when you trade. Criteria involved in this technical analysis include a lot of things, like for example, looking at the stock's moving average. For example, is its 200-day moving average trending upwards? Is the short-term 50-day moving average above the 200-day? Is there an increase in volume, which may indicate interest in the stock? And what's the price movement in comparison to the volume, which is very important. Candles are a popular indicator. Black candles mean that your closing day price is higher than that day's opening price, which may mean that the stock price is on its way up. A long dark candle at the bottom of a price graph indicates that a stock price may have support there. There are many more technical indicators like RSIs and Fibonacci series. It's up to you to choose which you feel will do the best job of predicting market movements. I say choose the ones that institutions use and get on the same page as these large investors, since they often have the power to move a stock price with their trades. Using the same technicals that others use to predict which way a stock price will go plays into the herd mentality that's in the market. For example, if it always rains when the sky's dark, you can assume that the next time the sky is dark, it'll likely rain. Investors who use technical analysis look for the same patterns. So when you see a price pattern develop, you may have a good idea for what may happen next with the price, especially if large investors are looking for that same price pattern and react the same way that you do. Now let's put a combination strategy to work using both technical and fundamental analysis to pick a stock to trade. Let's look at Apple, a popular one. Some may say, hey, it has some of the hottest consumer products on the market, and Steve Jobs is well respected as the CEO, so why not buy the stock right now? Well, and that's a fair starting point, to look around at the products and services that you use and to consider investing in those companies. But before you do, put on your analyst cap and determine if it's a good stock to buy. In particular, if it's a good stock to buy right now. Apple has strong fundamentals. It has a strong business plan for continued future earnings, and at approximately $300 a share, some say that it's still undervalued and could potentially hit $400 in early 2011. However, fundamental analysis tells us a theoretical price target at some point in the future. It doesn't account for technical price forces that may cause the stock price to collapse. We saw this in 2008 when undervalued stocks with high price targets and strong fundamentals literally collapsed and started trading at distressed levels. Apple, with its strong fundamentals, went from $175 to just under $90 a share in 2008. In other words, while its fundamentals looked good, its technicals showed that its price was on the way down. So if you bought Apple then, you possibly could have lost money at first, almost half your investment, when the price fell from $175 to $90 a share due to downward price forces from traders selling in reaction to the economic collapse. Isn't that something? But fast forward to today. Now Apple's strong fundamentals helped it roar back from $90 to just over $300 a share. And the company's investing back into itself and has a faithful customer base and strong ideas. So Apple will likely hit $400 a share based on strong fundamentals and strong growth prospects. But we can't say when. In the short term, technical signals as of Friday, November 19, 2010, say that its price may pull back until, for example, the 50-day moving average crosses back above the 200-day moving average and is ideally supported by trading volume. The good news is that market forces on the whole are now fairly stable and have been trending upwards since QE2 was mentioned by Fed Chairman Ben Bernanke in October in a speech. So in theory, the combination strategy says that Apple may be a profitable long-term addition to your portfolio, but perhaps wait until its price is back on an uptrend before buying so that you don't lose money in the short term. This isn't a recommendation to buy or sell, but this is a recommendation to try out and use multiple analysis techniques to determine if a stock fits your long-term or short-term objectives. So in conclusion, we learned about fundamental analysis and technical analysis and how to use them both together to potentially set yourself up to make a profit. So the next time you consider buying a stock, don't look at how hot or popular the stock is. Analyze the company behind the stock and use technicals to determine what may be a good time to jump into the cab or to jump out. As always, thank you for watching and subscribing. This is the Wall Street Geek, hoping that you live long and profit. Take care. Bye.